There's nothing to say that the bull market in gold and silver has been broken yet, not at all. But it doesn't mean to say that we're not in this consolidation phase where we might go sideways for a period. But of course, that can change. It depends who comes in as buyers.
November gold and silver that you're already seeing people setting up for delivery.
What does it mean? It doesn't mean to say the gold is leaving COMEX, but when a delivery notice is given, it means that one owner is accepting to, or one owner's asked for delivery. It's changing hands to a new owner. So the new owners are keeping their gold in COMEX, but they've asked for delivery. So basically, the ownership of gold is changing a lot, much more.
Gold's rapid rise and pullback have renewed scrutiny of changing ownership patterns, as analysts Mario and Clive question who is buying and why the metal is shifting between major custodians. Mario Innecco observed that around mid-October gold peaked near $4,380 after a rapid rise from $4,000 the previous week, a move he viewed as unsustainable, making the later correction unsurprising. By the time of discussion, gold was trading around $4,020, while silver had rebounded to $49.11 after dipping below $46. He noted that if silver maintained this level, it could mark its highest monthly close ever, surpassing the previous $47.90 record. Mario also pointed out that major bullion banks such as HSBC and JPMorgan Chase act as primary custodians for gold ETFs, suggesting that HSBC's recent increase in gold holdings might be linked to ETF sourcing, though he acknowledged this remains speculative. Clive Thompson agreed that the recent price correction was not unusual and explained that many late entrants to the gold market had purchased with leverage, making them vulnerable to even small downturns. As prices dipped, these traders exited quickly, leading to short-term volatility. However, he emphasized that this did not mark the end of the bull market for gold or silver, but rather a period of natural consolidation. Clive also discussed an interesting shift in COMEX gold holdings. Brink's reserves had fallen from roughly 15.2 million to 11 million ounces, and JP Morgan's from 8.2 to 7.1 million, while HSBC's holdings rose from 5.9 to 7.25 million ounces. He noted that although total COMEX gold volume remained steady, the ownership pattern had changed significantly, implying large-scale transfers between institutions. This movement, Clive suggests, might indicate HSBC taking on a greater custodial role, possibly linked to the ETF activity Mario mentioned. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
So Clive, I was surprised 2-3 weeks ago. I don't remember now exactly. I think it was October 16th was when gold topped at 43.80, and that was on a Friday. And I remember speaking on my video that that week I had lost track of the gold price because it went from 4,000 the previous week to 4,400 or 4,003, was it 4,380? And I said, this is just very quick. So I'm not surprised we had that big correction. But I think as I look here this morning, Clive, gold is at 4,020, and silver, interestingly, a few days ago, it got down to like below 46, and it's now at 49.11. And I was looking at the monthly chart going back a long time. The highest closing monthly level for silver is 47.90. So if we can stay around here till the end of the day, this will be the highest monthly closing. So I think this is just shaking the week longs, and I think a lot of the speculators in the futures and over-the-counter markets got overstretched, and they've gotten taken to the cleaners. Is that how you see it?
There were a lot of people who came in quite late in the day and bought gold with leverage, and obviously, when you have that type of situation, even a small move down can shake them out because they get scared very quickly. So I actually got quite a lot of messages in my inbox saying, Clive, well, I was in China, this was saying, we were already in China when it soared up above 4,000, and then the messages came saying, Clive, what's going on when it plunged? And I couldn't reply to everybody, but I think the gist of it was that weak holders were suddenly getting very nervous and they see the direction of travel and say, oh my God, it's on its way back to zero or whatever the number they got in their head. No, I've been around markets for 50 years, not just gold, but equities, everything under the sun. And this is the way bull markets behave. They climb a wall of worry. They go up, up, up for weeks on end. Then suddenly you have a ratchet down and it's short, it's fast and it's furious. And then a lot of people think, wow, it's going to nothing. They sell and then it bounces. And then you have a little period of consolidation, which you can't say that it lasts a week or a month or 3 months. There's no rule here. But there's nothing to say that the bull market in gold and silver has been broken yet, not at all. But it doesn't mean to say that we're not in this consolidation phase where we might go sideways for a period. But of course, that can change. It depends who comes in as buyers. I did notice something, Mario, which I just draw your attention to, and I don't know if anyone can crack it because I can't figure out what's going on. But I've been looking at the COMEX numbers, and there's something very odd going on, which maybe someone can solve it for me. But I see that gold is moving from Brinks and from JPMorgan to HSBC. So if I go back to March this year, Brinks had 13.8 million ounces in COMEX, and JP Morgan had 8.2 million ounces. Brinks has gone down from 15.16. So Brinks has gone from 15.2 million down to 11 million, and JP Morgan's gone down from 8.2 million to 7 million, 7.1 million actually. But at the same time, the gold held by HSBC, which was 5.9 million, has gone up to 7.25 million. So although the gold is staying in COMEX, it's changing hands, which is, you've got to ask, who are the clients of HSBC on whose behalf they're holding it? And we know it's changing hands because we're seeing these delivery notices every month after month, without exception. If you give me a second, I'll show that to you, Mario. The delivery notices are many multiples of what they were last year.
I'm looking here, Clive, gold ETF custodian, and it says that the primary custodians for gold ETFs are large bullion banks such as HSBC and JPMorgan Chase. So I don't know, maybe HSBC has to source some gold for ETFs. I'm not sure.
It could well be that they're holding it for ETFs, but it's strange that the gold has moved from other owners, Brinks, yeah. I mean, they're obviously custodians for third parties, Brinks, so it's moved from JP Morgan and Brinks to HSBC. So somehow, maybe HSBC is one of the custodians. I don't know whether the custodian for the ETFs.
Mario Innecco noted that traders were already positioning for physical delivery in the November gold and silver contracts, signaling early activity in the COMEX market. He explained that a delivery notice doesn't mean the metal is leaving COMEX, but rather that ownership is transferring between parties. Turning to monetary policy, he observed that if the Federal Reserve plans to restart quantitative easing, QE, it would be easier to do so after halting quantitative tightening, QT. Mario also recalled Jerome Powell stating that the Fed's balance sheet had shrunk by just over $2 trillion, like the $1.8 trillion in U.S. Treasuries held in the Cayman Islands, hinting at possible links between global liquidity flows and gold market movements. Clive Thompson highlighted that COMEX data shows a notable surge in delivery activity, with November 2024 delivery notices for both gold and silver already surpassing the totals for all of November last year even before the month began. He emphasized that this reflects increased changes in ownership rather than gold leaving COMEX vaults, suggesting stronger investor demand for physical possession. Clive advised viewing gold as a long-term safeguard and asset that provides independence and security, unlike bank deposits that can be restricted or frozen during financial stress. Let's get back to the interview.
November gold and silver that you're already seeing people setting up for delivery.
Yes, let me show you. You can now see on the screen the COMEX gold delivery for 2024 in the left-hand column and then 2025 in the right-hand column. So the delivery notices for November, and don't forget we haven't even started November yet, so that people have been giving the delivery notices today or yesterday for the 1st of November. Delivery notices for November already exceed the totality of the delivery notices for the whole of the month of November last year. And that's true for both gold and silver, which you see on the right-hand side of the screen. So what does it mean? It doesn't mean to say the gold is leaving COMEX, but when a delivery notice is given, it means that one owner is accepting to, or one owner's asked for delivery, it's changing hands to a new owner. So the new owners are keeping their gold in COMEX, but they've asked for delivery. So basically the ownership of gold is changing a lot, much more, because in the past it was like 1% of the contracts would be would be going for delivery notices. In the month of May, we had 100% of the open contracts for that month where basically delivery was taken. And we're seeing typically now something like 20 or 30% of the contracts open being delivered. In other words, ownership is changing. We don't know from who or to who, but maybe someone can crack it for me. But there's some rotation going on there.
And also, delivery doesn't mean to say, like you said, it just changes hand. But when it leaves COMEX, you need to get a warrant issued, right? That's how it leaves COMEX.
Yeah, I mean, it's a risky situation, and if it goes wrong, the Federal Reserve will have to step in with new lending facilities to try and stabilize the markets, as has happened in the past.
Do you think that's why they're going to stop QT, or that's a different story?
Well, I think that's a different story. I mean, by stopping QT, they're basically ceasing to withdraw money from the market, and it keeps the gravy train of every asset going higher. I mean, when they were doing QT, what that was doing was basically they were selling bonds that the Federal Reserve owned into the market and collecting the cash. So they were taking cash out of the economy, basically slowing the economy, if you like, in a certain sense. But now, without that withdrawal of cash, it means the cash in the economy will build up and people will buy things. And that's why I think the gold prices has gone back up from that recent dip.
Yeah, and the other thing as well, if they want to do QE, it's much easier to start it after you've stopped QT. And it's interesting that I heard Jay Powell speaking the other day, and he said they got their balance sheet shrunk by just over $2 trillion, which is fairly similar to this 1.8 trillion dollars of treasuries in the Cayman Islands. So I'm going to stop here, Clive. And yeah, just anything you wanted to tell the viewers before we sign off?
Well, I think there's a lot of people who are quite nervous about the swings in the gold price. If you don't own any, then I think the way to play it is buy a little bit and see how you feel, and then keep lots in reserve to buy another day. And it doesn't really matter if you buy higher or lower than today's price. That's not the important thing. The important thing is to get to the amount that you'd like to own in the end, little by little, and then you have to just keep it for the long term as kind of like an heirloom. It's your parachute. It's your emergency money. You know that it's not like, unlike your bank, it can't default on you. You don't have to ask gold for permission what you do with it. Whereas you want to move money in your bank. if they say you can, that's fine. If they say you can't, you can't. But if you've got the gold physically in your pocket or under your pillow or wherever you keep it, you can everywhere on the planet you can trade it. There's no one going to say no to you if you try and sell a gold bar or a gold ounce.
I agree, and I noticed, Clive, that when you got back from China last week, you went to a coin conference in Zurich, and that you loaded up on some gold and silver, didn't you?
Yeah,
So
I did. I bought about 10,000 pounds worth, I suppose, of gold coins of various descriptions, mostly British sovereigns, as it happened, and I felt very pleased with myself because a lot of people who were selling gold and silver had fairly good prices. You always pay a little bit more than the gold price, but there was a lot of choice, lots of good prices, and I got myself one. It was a silver. I got one of the pieces which I really like. That's my favorite. It's a silver bar from the Cook Islands. Beautiful piece. I paid 60 Swiss francs, the price on the thing, and it's 50 grams. So anyone who wants to do the maths could work out. I didn't pay much.
that's 1.6075 ounces, just to let you know. So,
Yeah.
yeah, so I guess
But
it's a good price, 60 francs.
I mean, for the beauty of it, definitely.
Yeah.
I mean, this is the other thing. Those who do buy gold, you stop concentrating on the fact that you buy it at one price and you sell it at a lower price because there's always a difference between the buy and sell price. What you have to concentrate on is you are buying something which might be very useful to your family and to you down the line.
Rising COMEX delivery volumes point to a clear shift in investor behavior, with more participants opting for physical ownership rather than exposure through paper contracts. This growing demand for delivery reflects deeper confidence in gold's intrinsic value and a desire for direct control over tangible assets. At the same time, the broader backdrop of changing Federal Reserve policies and global liquidity movements continues to influence market sentiment, prompting investors to seek stability in assets that lie outside traditional financial systems. The pattern suggests both prudence and conviction: prudence in recognizing systemic vulnerabilities and conviction in gold's historical role as a dependable store of wealth. In an environment of monetary uncertainty and shifting economic dynamics, physical gold stands out as a long-term anchor of independence, security, and trust. How might the growing shift toward physical gold ownership affect market liquidity and price stability in the coming months? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.